Today, the Fed's balance sheet BS. Hi again, it's Martin North from Digital Finance Analytics. Welcome to this post covering finance and property news with a distinctively Australian flavour. Well, the markets and analysts are all focusing on the potential for the Fed to lift interest rates this year, perhaps 3 times or significantly more. But actually, we think the Fed's balance sheet is where much of the action and market attention should be. It's already indicated it may be ready to start raising interest rates, dial back on its bond buying program, and engage in high-level discussions about reducing holdings of Treasuries and mortgage-backed securities. The process of reversing the trillions of dollars of pandemic bond purchases, or quantitative easing, is technical, wonky, and frankly somewhat opaque. Interest rate hikes are yesterday's news, Morgan Stanley Managing Director Jim Caron told Yahoo Finance on Tuesday. Caron said the main thrust of Fed policy will come from how it undoes the stimulus coming from its balance sheet. Because of the massive amount of buying in response to the pandemic, the Fed owns about a third of both the Treasury and mortgage markets. If the idea for higher rates is to curb inflation, long-term rates won't really rise until the Fed's huge footprint diminishes, rendering rate increases on their own ineffective if bond markets aren't speaking for themselves. The latest weekly Fed total assets less eliminations was released on Wednesday, as reported by the St. Louis Fed. Total assets were $8.788 trillion, up by 0.26% this week. Yes, in the week when Powell underscored inflation was the battle now to be won, over against full employment, and that balance sheet reductions were on the cards. We're mindful that the balance sheet is $9 trillion. It's far above where it needs to be, Powell told Congress in testimony on Tuesday. But the question is, how should the Fed time interest rate hikes with any balance sheet unwind, and does it matter? In his testimony this week, Powell said balance sheet shrinkage could run sooner and faster. That much is clear. But he avoided giving any more details, in part because the debate among officials is still underway. But he did say it's a long road to normal from where we are. In fact, after a brief pause, the US Federal Reserve is again expanding its balance sheet, thus continuing to support asset prices. The US Central Bank added nearly $31 billion to its balance sheet in the last 2 weeks, something which will generally support equity markets. The consolidated size of the Federal Reserve balance sheet reached $8.788 billion on Wednesday, the 12th of January, up from $8.765 billion a week ago, and just a notch below the all-time high of $8.79 billion on December the 22nd, 2021. In December, the Fed reduced its balance sheet twice in the first and last weeks of the month, and the Fed action was accompanied by a sell-off in equity markets and a decline in emerging market currencies. So there is actually a fair correlation between changes in the balance sheet and recent changes in the equity market. Traders in most markets had created many short positions in the months of December and November last year in anticipation of tapering by the Fed. These trades are now unwinding, or short covering of positions, leading to a price recovery in most risk assets, including equities, commodities, and emerging market currencies. The US Federal Reserve has expanded its balance sheet by around 20%, or $1.425 trillion, since the beginning of 2021 calendar year. And the Fed uses those additional dollars to purchase financial assets such as US government bonds, mortgage-backed securities, and corporate bonds. This expands liquidity in financial markets and leads to a rally in bonds and equity prices. Now, according to the Federal Reserve, it will cut its asset purchase program by the month of March this year, and then start selling down its stockpile of bonds in a bid to shrink its balance sheet. Chair Jerome Powell said this week that balance sheet runoff could start later this year, but officials don't really know how that will impact overall financial conditions. Letting it shrink has the same effect as rising rates, and could mean that they'll have to hike rates less than otherwise, but it's hard to be precise. Bill Nelson, Chief economist at the Bank Policy Institute in Washington said part of the problem with Fed guidance is that it was never built for current conditions. The Fed retooled its signals to markets in August 2020, saying that it wouldn't hike until inflation overshot its 2% target and the economy was at full employment, essentially embedding an inflation bias into policy. That was designed for an era when inflation was too low, but now they face the opposite problem. If Fed officials can't get a grip on inflation, they have to slow the economy. They say that they have the tools, but there is really only one tool, and that is to push up unemployment. And nobody really wants to talk about that, Nelson said. The Federal Reserve is behind the curve when it comes to shrinking the balance sheet, according to UBS Global Wealth Management's Kelvin Tay. Fed Chairman Jerome Powell said on Tuesday that he expects a series of interest rate hikes this year, along with other reductions in the extraordinary help the central bank has provided during the pandemic. If you take a step backwards and you listen to what he said, he hasn't actually acknowledged that the Federal Reserve is actually behind the curve, but they certainly are, Tay told CNBC. Tay noted that US stock markets are doing relatively well, and corporate earnings in the second and third quarter of last year were also at multi-decade highs. And at that point, you are still printing, he said. So you must be wondering why they are still printing at this level, right? He said, adding key developments going forward will be how fast and how much the Fed shrinks its balance sheet. To get ahead of the curve, Tay says the Fed could start normalising the balance sheet earlier than expected. There is a 75% chance the Federal Reserve will hike in March when tapering ends. The debate now is whether it's 2 or 3 hikes where the market is concerned. It could be 4 hikes this year as well, he said. He added there could be complications, especially if supply chain pressure eased in the coming months, as this could reduce inflation expectations going forward. That means the Federal Reserve may not have to start normalising the balance sheet as early as we actually expect, Tay said, adding the situation at this stage remained fluid. And Tay also underlined the Fed's faster policy tightening cycle is likely to impact Asian countries, especially emerging markets in the region. If your US Treasury yield on a 10-year basis goes up to 2 to 2.5%, then the yields on this part of the world where the government sovereigns are concerned will have to behave accordingly, he said. This will affect some of the economies in Asia, given their higher debt levels, he added. In 2013, the Fed triggered a so-called taper tantrum when it began to wind down its asset purchase program. Investors panicked and it triggered a sell-off in bonds, causing Treasury yields to surge. As a result, emerging markets in Asia suffered sharp capital outflows and currency depreciation, forcing central banks in the region to hike interest rates to protect their capital accounts. Tay says aggressive Fed policy could potentially slow the economic recovery in Asia. That's not something that you want at this point in time, because at this point in time, a lot of the economies here are still struggling to recover from the COVID-19 pandemic, he said. During the last economic expansion, the transition through the stages of monetary policy normalization was very slow. The balance sheet runoff didn't begin until about 3 years after the Fed completed its asset purchase program. This time around, though, the interval might be much less, perhaps less than a year. The question is, how does a potential faster transition interact with lower levels of short-term interest rates? During the previous cycle, it began only after the Fed funds rate target was above 1%, with the central bank poised to raise rates multiple times in 2022. That level could be reached by the end of the year. Some Fed officials have argued that quantitative tightening should begin even sooner at a lower federal funds rate, with the aim of pushing up longer-term interest rates and supporting financial institutions which tend to lend at long-term rates and borrow at short-term rates. But the question is, would starting at a lower rate conflict with the Fed's commitment to the federal funds rate as the primary tool of monetary policy? If you emphasise getting the federal funds rate up above 1% first, then you'll have more ability to reverse course and use it as a stimulative tool if the economy gets hit with an adverse shock. Officials understand the effect of interest rate changes much better than that of balance sheet changes. This is why they employ the latter only in extreme cases when interest rates have hit the zero lower bound. Fed officials also discussed the turmoil in money markets that the last episode of quantitative tightening helped trigger. As the central bank shrank its balance sheet, it has also reduced the aggregate amount of reserves in the banking system. In September 2019, reserves fell below the level that banks desired, making them reluctant to lend short-term and causing rates to spike in the repo market, where various financial institutions borrow money to fund investments in Treasuries and other securities. Perhaps there is much less risk of this happening again because the Fed has since established a broad-based standing repo facility that financial institutions can access quickly if they need funds. But another issue is the composition of its holdings. Since March 2020, the Fed has been purchasing both Treasuries and agency mortgage-backed securities, but its longer-term goal is to hold only Treasuries. So some Fed officials have suggested allowing the mortgage-backed holdings to run off more quickly, or even reinvesting the proceeds into Treasuries. High inflation and a strong recovery will require the Federal Reserve to raise interest rates at least 3 times this year, beginning as soon as March, and warrants a rapid rundown of Fed asset holdings to draw excess cash out of the financial system. In fact, Atlanta Fed President Raphael Bostic said there is a risk inflation is likely to be elevated for an extended period of time, and we need to respond directly, clearly and aggressively. He said, if things continue the way they are, March would probably be a reasonable probability for the first of what would be a series of interest rate increases to offset inflation running far above the Fed's 2% target. And he added he does not feel the explosion of new coronavirus infections will derail the recovery, but to the contrary, feels it more likely inflation will intensify further and require a 4th quarter-point rate increase in 2022 than it slows and allows the Fed to relax. His remarks reflected the Fed's turn towards inflation fighting, a shift cemented at the December meeting, where officials accelerated plans to raise interest rates and begin to pull back on their holdings of US Treasury bonds and mortgage-backed securities accumulated during the pandemic. Bostic, in detailed remarks about the management of the Fed's balance sheet, said the central bank should be aggressive there as well, allowing its holdings to decline by at least $100 billion a month, and with plans to quickly pull at least $1.5 trillion out of financial markets that he considers pure excess liquidity. From 2017 to 2019, when the Fed was shrinking its balance sheet years after the end of the 2007 to 2009 recession, it phased the pace of declines in slowly, capped it at $50 billion a month, and ultimately decreased its balance sheet by only $600 billion before financial market signals the system did not have enough cash reserves at hand. The process promises to be much different this time, and Bostic, for example, says he felt that there was no need to phase in any balance sheet runoff because markets know what to expect. I would hope we would move pretty quickly and get out of this emergency stance, Bostic said. The tool is pretty well understood and the motivation is pretty well understood. It should go faster for sure, Bostic said, and at a quick enough pace to complete the process in a couple of years. Conveniently, the Federal Reserve Board on Friday announced preliminary financial information indicating that the Reserve Bank has estimated net income of $107.8 billion during 2021, of which $107.4 billion was remitted to the US Treasury as required under the Federal Reserve Act. The $170.4 billion for 2021 was the second highest amount behind the record in 2015. The Federal Reserve Act requires the Reserve Bank to remit excess earnings to the US Treasury after providing for operating expenses, payment of dividends, and the amount necessary to remain surpluses. The 2021 audited Reserve Bank financial statements are expected to be published later this year and may include adjustments to these preliminary unaudited figures. And by the way, the auditor is KPMG. The Federal Reserve Bank's 2021 estimated net income of $107.8 billion is an increase of $19.3 billion from 2020. But the Fed's term net income is, well, frankly, somewhat bizarre for an organization that buys trillions of dollars of securities with money that it itself created. The increase is primarily from a $25.1 billion increase in interest income associated with US Treasury securities, offset by decreases in interest income on federal agency and government-sponsored enterprises, mortgage-backed securities of $2.7 billion, and a decrease of $3.4 billion in the annual amount of net gain or loss that results from the daily revaluation of foreign currency-denominated asset holdings at current exchange rates. The net income for 2021 was derived primarily from interest income on securities acquired through the open market operations, US Treasury securities, federal agency, and GSE mortgage-backed securities, and GSE debt securities of $122.4 billion. That was offset by interest expenses associated with reserve balances held by depository institutions of $5.3 billion, foreign currency revaluation losses of $1.9 billion, and interest expenses of $414 million on securities sold under agreement to repurchase. The Federal Reserve banks realised net income of $235 million from facilities established in response to the COVID-19 pandemic. The Fed doesn't pay income taxes, but it remits nearly all of its net income to Treasury departments as required under the Federal Reserve Act. Operating expenses of the Reserve Bank, excluding amounts reimbursed by the US Treasury and other entities for services the Reserve Banks provided as fiscal agents, totaled $5.3 billion in 2021. In addition, the Reserve Banks were assessed $1 billion for the costs relating to producing, issuing and retiring currency, $970 million for board expenditures, and $628 million to fund the operation of the Consumer Financial Protection Bureau. Additional earnings were derived from income from services of $457 million. Statutory dividends totaled $583 million in 2021, and the Fed paid that $583 million in statutory dividends to the shareholders of the 12 regional Federal Reserve banks. The amount represents about 0.55% of its net income. Those 12 Federal Reserve boards include the New York Fed, the St. Louis Fed, the San Francisco Fed, the Dallas Fed, etc., etc. Their shareholders are the largest financial firms in their districts, so that's a nice little earner for them. And finally, what of so-called forward guidance? Well, central bankers over the past 2 decades abandoned deliberate obfuscation in favour of clarity about their expectations for where they planned to take policy. Former Chairman Ben Bernanke introduced forecasts and the now famous dot plot, where all Fed officials actually display their rate outlook. September's dot plot showed 1 hike this year, but by December that had climbed to 3. And on Thursday, Fed Governor Christopher Waller said that it could take as many as 5 moves, though it could be fewer if price pressures eased as expected. If inflation is just stubbornly high through the first half of this year, we're going to have to do a lot more, Waller said. Others have started to ring the 4-hike bell. Patrick Harker, the Philadelphia Fed president, who is expected to vote on the policy committee until Boston finds a new president, says he's written down 3 hikes. I could be convinced of a 4th if inflation is not getting under control. And Governor Lael Brainard, nominated to be the next vice chair, told lawmakers that she's cautious about the prediction that inflation will slow to 2.5% by the end of the year. We will simply have to see what the data requires over the course of the year, she said, referring to rate increases. Current Fed guidance explicitly ties a rate increase to achieving maximum employment. Unemployment fell to 3.9% in December, and officials meeting that month thought they were near a fully recovered labour market, according to minutes of the closed-door debate. The guidance is likely to be retired this month, though, as the Fed prepares to raise rates in March. The formula officials used back in 2015, the last time they got ready to lift off from zero rates, promised only gradual increases. It probably can't be used again. What do they say? Said William English, a former senior Fed economist who once helped policymakers craft answers to such questions. Given the uncertainties, it will be hard to say they're going to raise rates gradually, said English, now a professor at the Yale School of Management. My guess is the guidance will be very limited. Central bankers elsewhere are also sceptical of peering too far into the future. The Bank of England Governor Andrew Bailey said in November that making hard commitments on a rate path is hazardous in a more uncertain world. For the Fed, the task is even more complicated because it will be using 2 policy tools at once, interest rates and its balance sheet. Judging by the minutes of their December policy meeting, Fed officials are already working on a plan. It will bear similarities to the last quantitative tightening that began in October 2017, in that it will entail allowing the holdings to mature with caps limiting the monthly amounts, and it will be communicated well in advance and will be secondary to the Fed's main policy tool, the federal funds rate. But officials also noted 2 key differences that suggest quantitative tightening will start sooner after interest rate liftoff, and it will go faster. First, the economic outlook is stronger, with higher inflation and a tighter labour market. And second, the Fed's holdings are much larger and of shorter average maturity. So in this case, quantitative tightening is meant to reverse the quantitative easing, or QE, launched in response to the COVID-19 pandemic. As Joseph Wang, previously a senior trader on the Fed's open markets desk, said, quantitative tightening is when the Fed receives principal repayments from its Treasury holdings but does not roll them over into newly issued Treasuries. The reserves disappear from the banking system with a few keystrokes, just as they appeared with a few keystrokes during QE. Wang says. It's unclear, but some strategists and economists think QT could start soon after QE ends in March, and just as rate liftoff is expected to occur. Now, last time the Fed said about unwinding QE in 2017, but there was a 2-year lag. Still, Wang expects the Fed to proceed cautiously with quantitative tightening because it is draining bank reserve balances without knowing the minimum level of reserves the financial system requires to function. Last time the Fed started reversing QE in 2017, it started with a monthly pace of $6 billion a month of Treasuries and ramped up to $30 billion a month. It slowed the pace of QT in mid-2019 before ending it later that year after a sudden spike in repo rates, or the rate at which market participants swap treasuries for cash to cover short-term cash needs. Maturing principal that is in excess of the Fed's stated QT pace is rolled over at auction, said Wang. He gives this example: if the Fed receives $20 billion in maturing principal but has capped the pace of QT at $15 billion a month, then it will roll over $5 billion into the next Treasury auction. It's unlikely the Fed will fully reverse all of the QE launch since the start of the pandemic, meaning the balance sheet probably won't go back anywhere close to $4.5 trillion. Torsten Slock, chief economist at Apollo Global Management, says there is clear disagreement within the Federal Reserve System over how high reserve balance sheet should be and thus how high the balance sheet should stay. But he doesn't think the intention is to fully remove all of the liquidity currently supporting markets. And Wang notes that during the last round of QT, the Fed frequently surveyed banks to gauge their minimum level of reserve requirements. Based on those surveys, he says QT could have gone on all the way until 2021. He and Slock note current high levels of liquidity in the reverse repo system is one sign of just how much extra liquidity is sloshing around, and it's evidence that balance sheet shrinkage is necessary. Robert Purley, head of global policy research at Cornerstone Macro, sees the Fed's balance sheet at roughly $8 trillion by the end of next year. As Slock of Apollo puts it, if you think QE buying mattered for boosting risk assets, lowering interest rates and narrowing credit spreads, then you must have the symmetric view that QT selling will have the opposite effects. And the Fed is focused on broad financial conditions beyond the Fed funds rate and including things like financial markets and borrowing costs. Slock says the idea is that if the Fed is setting up to tighten financial conditions, it is attempting to curtail risk-taking. But there is one way this time is different from other rounds of tightening. Asset valuations are quite stretched, says Slock, meaning financial markets are far more vulnerable to balance sheet shrinkage and rate increases than in the past cycles. And the upshot of this, well, it will therefore take less to tighten financial conditions, and with markets in effect doing some of the Fed's work for it, the central bank may have to do less portfolio shrinkage and fewer rate increases than it otherwise might. And here is another more technical way that this time is different. Barry Knapp of Ironside's Macroeconomics notes that the development of the Fed's reverse repo program, in addition to its standing repo facility, has created lower and upper bounds for repo rates and should make running down the balance sheet more orderly. The program, he says, increases the Fed's confidence that it can shrink its portfolio quickly without another repo rate spike like they had in September 2019. So if you stand back, you can see just how complex this whole question of the balance sheet is. And I remind you where I came into this conversation, the Fed is still increasing the balance sheet at the moment. And the question, of course, really is, if they start reducing the size of the balance sheet, what will happen to the financial markets? Will they once again wilt away? Well, that is the most likely outcome in my view, which is why I think this year is about to be a very, very wobbly year for the financial markets. I'm Martin North from Digital Finance Analytics. Many thanks for watching, and I'll see you again next time.